You're listening to this article from Convertz.app. Trump tariffs in 2026. How the biggest trade war in 80 years is hitting your wallet and exchange rates. The return of tariffs. What's actually happening? In early 2025, the Trump administration launched the most aggressive tariff program the United States has seen in nearly 8 decades. By February 2026, the effective tariff rate on U.S. imports has climbed to approximately 22%. A level not seen since the Smoot-Hawley era of the 1930s and 1940s. For context, the average U.S. tariff rate was around 2 to 3% as recently as 2024. This isn't a targeted action against one country. It's a sweeping restructuring of American trade policy that touches virtually every imported product and, by extension, every consumer. What tariffs are currently in place? China, the biggest target. China has been hit hardest, with tariffs now reaching 145% on many categories of goods. This includes electronics, smartphones, laptops, tablets, and components, clothing and textiles, fast fashion, sportswear, and fabrics, industrial components, steel, aluminum, rare earth magnets, consumer goods, toys, furniture, kitchenware, small appliances, auto parts, batteries, EV components, and finished vehicles, up to 270% combined. China has responded with retaliatory tariffs of 125% on American goods, including agricultural products, energy, and manufactured goods. Other major trading partners: Canada and Mexico, 25% tariffs on most goods, 10% on Canadian energy. Both have retaliated with tariffs on U.S. exports. European Union, 25% tariff on steel and aluminum, 25% on automobiles, as of April 2025. The EU responded with tariffs on $28 billion worth of U.S. goods. Japan and South Korea, 25% on automobiles and auto parts, plus baseline tariffs of 10 to 24%. Everyone else, a blanket 10% baseline tariff applies to imports from virtually all countries not already subject to higher rates. The reciprocal tariff system. The administration introduced a formula-based tariff system it calls reciprocal tariffs, calculated based on the trade deficit with each country rather than matching their actual tariff rates. This has resulted in some unusually high rates: 46% on Vietnam, 49% on Cambodia, 36% on Thailand, and 32% on Taiwan. A 90-day pause on some of the highest reciprocal tariffs was announced in April 2025, but most have since been reimposed or replaced with sector-specific rates. How tariffs are hitting consumer prices. The numbers don't lie. The Tax Foundation estimates that tariffs at current levels represent a $2,100 to $3,900 annual tax increase per U.S. household, depending on income level and consumption patterns. Lower-income households are hit disproportionately because they spend a larger share of income on imported goods. Here's what's already happening on shelves and online. Electronics and technology. Smartphones. The average price of a new smartphone has risen by an estimated 15 to 20%. Apple reportedly absorbed some early tariff costs, but has begun passing increases to consumers. Laptops. Budget laptops that previously sold for $300–400 now start closer to $400–500. Gaming consoles. The PlayStation 5 and Xbox Series X have seen price increases of $50–100 in retail channels. Components. Graphics cards, SSDs, and RAM modules have increased 10 to 25%. Clothing and apparel. About 97% of clothing sold in the U.S. is imported, with tariffs of 25 to 145% depending on origin. Fast fashion retailers have raised prices 15 to 30%. Athletic footwear is up an average of $8–15 per pair. Children's clothing, previously almost entirely sourced from China and Southeast Asia, has seen some of the steepest increases. Automobiles. This is where tariffs hit hardest in absolute dollar terms. New car prices have risen an estimated $4,000–12,000, depending on the vehicle and how much of the supply chain crosses borders. Even American-made vehicles contain 30 to 50% foreign parts, meaning tariffs affect virtually every car sold in the U.S. Used car prices have risen in sympathy as buyers avoid the new car premium. Food and groceries. Avocados from Mexico. Prices up 20 to 30%. Roughly 80% of U.S. avocados are imported from Mexico. Canadian beef and pork. 25% tariff has raised meat prices at the counter. Seafood. Much of the fish sold in the U.S. is caught domestically but processed in China before being shipped back. These products face tariffs both ways. Beer. Aluminum can tariffs have added 5 to 10 cents per can across all canned beverages. Coffee. While beans themselves have varied tariff treatment, processing equipment and packaging costs have risen. Home goods and construction. Lumber from Canada. Tariffs have contributed to higher costs for new home construction and renovation. Steel and aluminum. These upstream tariffs ripple through everything from appliances to canned goods. Furniture. Most budget and mid-range furniture is imported from China or Southeast Asia and has seen 15 to 35% price increases. What's happening to the U.S. dollar? The dollar has weakened, not strengthened. Traditional economic theory suggests tariffs should strengthen a country's currency. By reducing imports, they reduce the outflow of domestic currency, increasing demand relative to supply. But the real world is more complicated. Since the tariff escalation began, the U.S. dollar index, DXY, has fallen approximately 6 to 8% from its early 2025 highs. Here's why. Number 1. Uncertainty crushes investment. Foreign direct investment in the U.S. has slowed as companies question the stability of trade policy. When tariff rates can change via executive order overnight, businesses hesitate to commit capital. Less foreign investment means less demand for dollars. Number 2. Retaliatory tariffs reduce U.S. exports. American farmers, manufacturers, and service providers are losing access to foreign markets. China's 125% retaliatory tariffs have effectively shut U.S. agricultural exports out of the world's largest food import market. Fewer exports mean less foreign demand for dollars to pay for American goods. Number 3. Central bank diversification. Foreign central banks have accelerated their move away from dollar-denominated reserves. The dollar's share of global foreign exchange reserves has fallen to roughly 54 to 57%. Down from about 72% in 2000. Tariff unpredictability is accelerating this trend. Number 4. Inflation expectations. Tariffs are inflationary. They raise the cost of imported goods directly and domestic goods indirectly because domestic producers face less competitive pressure to keep prices low. Higher inflation expectations weaken a currency's purchasing power and its attractiveness to foreign investors. What this means for exchange rates. If you're converting currencies right now, the weaker dollar means traveling abroad from the U.S. is more expensive. Your dollars buy fewer euros, pounds, or yen than they did a year ago. Sending money overseas from the U.S. costs more in dollar terms. Receiving money in the U.S. from abroad, you're actually getting more dollars per unit of foreign currency. Importing goods costs more. Tariffs plus weaker dollar is a double hit. U.S. exports become cheaper for foreign buyers, which is partly the point. Use our currency converter to check real-time exchange rates and see exactly how the dollar's movement affects your specific currency pair. The global ripple effect. Supply chain chaos. Companies don't just eat tariff costs. They reorganize entire supply chains to avoid them. This is happening at unprecedented scale. Vietnam and India have seen surges in factory construction as companies shift production out of China. But they're now facing their own tariff rates of 46% and 26% respectively. Mexico's nearshoring boom has been disrupted by the 25% tariff on Mexican goods, which contradicts the USMCA trade agreement. Tariff engineering, redesigning products to qualify for lower tariff classifications, has become a booming consulting industry. Currency volatility everywhere. The trade war hasn't just affected the dollar. Currencies of heavily targeted countries have experienced significant volatility. The Chinese yuan, has weakened against major currencies as export demand shifts. The Mexican pesos, saw sharp declines when tariffs were announced, then partial recoveries during negotiation pauses. The Canadian dollars, has been volatile, caught between oil price movements and trade uncertainty. Emerging market currencies broadly have suffered as global trade uncertainty drives capital toward perceived safe havens. Track these movements in real time with our currency converter. Who's winning? Nobody, really. The Peterson Institute for International Economics and multiple other research bodies have found that tariff costs are overwhelmingly borne by domestic consumers and businesses, not by foreign exporters. Studies of the 2018 to 2019 tariffs found that nearly 100% of tariff costs were passed through to U.S. buyers. The stated goal, bringing manufacturing back to the U.S., requires years of factory construction, workforce training, and infrastructure development. In the meantime, consumers pay higher prices for goods that were previously available more cheaply. What about inflation and interest rates? The Fed's dilemma. The Federal Reserve faces an awkward situation. Tariff-driven price increases look like inflation in the data, but they're not the same as demand-driven inflation that monetary policy is designed to address. Raising interest rates would strengthen the dollar but slow the economy further and increase borrowing costs for consumers already squeezed by higher prices. Cutting interest rates would stimulate the economy but risk compounding inflationary pressures from tariffs. Doing nothing risks letting inflation expectations become entrenched. Most forecasters expect the Fed to hold rates steady through mid-2026, while monitoring whether tariff-driven price increases are a one-time adjustment or the start of a persistent inflationary trend. Recession risk. Several major banks have raised their U.S. recession probability estimates. Goldman Sachs, 35% probability of recession within 12 months. Up from 15%. J.P. Morgan, 40% probability, up from 25%. Moody's warned that current tariff levels create material downside risk to GDP growth. GDP growth forecasts for 2026 have been revised downward from 2.5% to roughly 1.0 to 1.5%, with some models showing contraction in specific quarters. How to protect yourself. For consumers, Number 1. Buy durable goods now if you've been putting off major purchases. Tariff costs are still being phased in on some categories. Number 2. Look for domestic alternatives where quality is comparable. Some American-made products are now price competitive with imports for the first time in decades. Number 3. Compare prices across retailers aggressively. Different stores have absorbed or passed through tariff costs at different rates. Number 4. Stock up on non-perishable imports if you rely on specific products from heavily tariffed countries. For travelers, Number 1. Monitor exchange rates closely. The dollar's value is fluctuating more than usual. Use our currency converter to time your exchanges. Number 2. Consider locking in exchange rates through forward contracts or multi-currency accounts if you have upcoming trips. Number 3. Budget extra for overseas spending. The weaker dollar means everything abroad costs more. Number 4. Be aware of hidden exchange fees. Banks and card companies often widen their spreads during volatile periods. Read our guide on hidden fees when sending money abroad. For investors, Number 1. Diversify currency exposure. A portfolio entirely in dollar-denominated assets carries more risk when the dollar is weakening. Track live exchange rates. Number 2. Watch gold and safe haven assets. Gold has been surging as uncertainty mounts. Monitor gold prices with our metals converter. Number 3. Consider the crypto angle. Bitcoin and other cryptocurrencies are sometimes treated as hedges against currency debasement. Check real-time crypto prices. Number 4. Be cautious with companies heavily reliant on imports. Their margins are under pressure and earnings may disappoint. The bigger picture. The current tariff regime represents the most significant shift in U.S. trade policy since the creation of the World Trade Organization in 1995, arguably since the Bretton Woods system was established in 1944. Whether you view tariffs as necessary protection for American industry or as a self-inflicted economic wound, their impact on prices, currencies, and daily life is undeniable and measurable. The world's trading system is being rewired in real time. Exchange rates, consumer prices, and investment flows are all adjusting to a new reality. Staying informed and monitoring these changes isn't optional. It's essential for anyone who buys goods, travels internationally, or manages money across borders. Disclaimer: this article is for informational and educational purposes only and does not constitute financial, legal, or investment advice. Tariff rates, trade policies, and economic data cited are based on publicly available reports from the Tax Foundation, Peterson Institute for International Economics, U.S. Customs and Border Protection, Federal Reserve, and major financial news outlets as of February 2026. Trade policies are subject to rapid change. Always do your own research and consult qualified professionals for advice specific to your situation. That's the end of this article. Visit Convertz.app for more guides and free conversion tools.